I believe things are slowly breaking down beneath the surface of the stock market. I think the economy is slowly showing signs. And of course, economic data you can't trust. Everything's always being altered and changed, and numbers taken out and put in to those. So it's very hard to gauge when it comes to economic data, but you can feel it. You can see it in the charts, and money is just not wanting to commit. And of course, this last big bout of selling we've seen in the stock market started to raise quite a bit of eyebrows, got a lot of people really nervous. We're seeing lots of fear in this market. And I think it's really just the beginning.
On this episode of the What the Finance podcast, I have the pleasure of welcoming back Chris Vermeulen. So Chris is the founder and chief investment officer of technicaltraders.com. So Chris, thanks so much for coming back on the podcast.
Always a pleasure, Anthony. Love chatting. Yeah.
Yeah, looking forward to speaking because I think it's been quite a while since we last spoke, almost a year, which is crazy to think. And crazy 2024, lots of volatility. Markets went up, and then start of 2025 with return of the volatility again. But it'd be really interesting to hear sort of what you're sort of currently seeing in the markets.
Yeah, I think there's a lot of really interesting stuff unfolding. Obviously, now we've got a new president in the States who's, swinging his axe around and showing who's boss with all the tariffs and, wanting Canada to become part of the States. And he's just shaking things up. I think that's his style. And of course, it's wreaking havoc in the stock market and with interest rates and bonds and equities. We're seeing lots of that volatility take place. But overall, not a whole lot has changed in the grand scheme of things. Last time you and I spoke about a year ago, we were talking about how the market is in this stage 3 topping phase. This is a very long process. It can take several years, which it's already been a couple of years we've been in this. And a stage 3 is a topping phase in the stock market, in the economy, where momentum stalls. We see a big difference in who's buying stocks and what type of stocks are performing. Right after COVID, everybody piled in and chased the markets higher, and they were all playing the most aggressive type of stocks and sectors. Now we're really seeing most of those are down 40, 50, 60%. All the heavy lifting is done from the AI, the tech space, really holding the markets up and pushing the markets to new all-time highs throughout the last, over the last year. And 2024 is a very strong year for equities. But it's very sector driven. It's a very small pocket. Really, it's only 7 stocks doing most of the heavy lifting. That is not a good sign. That's not a healthy market. We want a broad stock market rally where all sectors and assets are rising and people are willing to risk their money and invest. But right now, it's really just a lot of people focused on driving money into a handful of stocks. And those stocks happen to be big heavyweights that when they move, they drag the whole market up. So when you look at the equal weighted market, or you look at the whole basket of small caps and large caps and micro caps, they're really put in a major double top last year. And which is very different than what you look at if you look at the SP 500 or the Dow or the NASDAQ. They're hitting new all-time highs, and they make things look very strong. But I believe things are slowly breaking down beneath the surface of the stock market. I think the economy is slowly showing signs. And of course, economic data you can't trust. Everything's always being altered and changed, and numbers taken out and put in to those. So it's very hard to gauge when it comes to economic data, but you can feel it. You can see it in the charts, and money is just not wanting to commit. And of course, this last big bout of selling we've seen in the stock market started to raise quite a bit of eyebrows, got a lot of people really nervous. We're seeing lots of fear in this market. And I think it's really just the beginning. I think the markets are a little oversold, ready for a bounce. But overall, the question is it a bounce, or is it the start of is it just going to be maybe a base for another leg higher in the markets, which I don't think is going to happen. But we just kind of have to see how the markets unfold.
Yeah, I have to wait and see. So do you see it sort of being similar to, I guess, what we saw at the end of I think it was 2022 and sort of start of 2023, or do you see it sort of something a bit more extreme? How are you sort of seeing it at the moment?
Yeah, well, based on technicals, which is my focus, I purely focus on technical analysis. I do pay attention to what's going on in the news and economic data to some extent, but it plays zero weighting into how we invest. As a technical trader, we follow price action and momentum. We want to know which direction something's going and how strong is it. And as you just mentioned, Anthony, we actually have a setup very similar to what was happening right at the end of 2021, the beginning of 2022, right when the stock market was starting to show signs of weakness. And then we went into the 2022 bear market. Now, there was a small little bear market, very short lived. But we have a very similar setup right now. Actually, the SP 500 has almost done the identical price action as it did on the weekly chart back in 2022, just before the market topped. But this time around, the overall technicals within the market of where money's flowing, how money's flowing, is very much different. It's much weaker than we saw in 2022. So I believe that this time around, this market actually may be putting in, or may have already put in, a major top. I think 2025 is going to be a very ugly year for stocks, but it's still topping. We need to see more of a breakdown. This is just a first kind of wave of weakness. And the question is, does this bounce that we have over the next few weeks, does it roll over and start to make some much lower lows and really kick us into a bear market phase, which then can bleed into a financial reset like we saw in 2008. We saw it in the tech bubble. I think we're going into something very big, a 30 to 50+% correction. And this year, right now, the technicals look very weak, much weaker than they did in 2022, just when the stock market had a small bear market.
Yeah, wow, amazing to see. Because I think, from our previous conversations, you've always said that you think this is on the horizon, you think this is could happen, but you've always been quite bullish because of the momentum. But now you're seeing sort of the complete opposite.
Mm-hmm. Yeah, so I'm definitely. I mean, I want to be long equities, but when they're not trending higher, we got to be very cautious. And I think there's some big red flags. In fact, if I share a chart here, I can show you. I believe we're in this topping stage. You should be able to see my chart here. The stage 3 is a topping phase. I have it colored red because it's choppy. It's difficult to trade. Most sectors aren't performing very well. It's just a handful. And the overall stock market, is definitely struggling. And I believe we're going to go into a stage 4, which is a financial reset, a decline. And this could last several years. It could take many years to get back to where we are right now. But the red flags that are really starting to show here are these cycles in the market. If we take a look at these cycles, what's interesting is when the stock market, this bluish cycle here, puts in a major top, we tend to see precious metals, more specifically gold, and we see energy stocks do really well. And we're seeing both of those. Gold's hitting new all-time highs. We have a huge amount of uncertainty in this market with Trump and just all kinds of data coming out, and earnings and things aren't as good as peachy as a lot of people want. So people move to precious metals as that defensive play. And I think a lot of people this time around are very scared about the banking system. They're worried about bankruptcies and losing all your money. So even if you did sell your stocks or you sold your real estate and you put that into the bank, your bank could go bankrupt and you could lose it. And I think this is the type of uncertainty that happens during a major market top. We've got wars going on. We got trade wars going on now, tariff wars. We've got, the United States trying to more or less take over Canada, depending on how you look at it. So we have a lot of uncertainty, and generally energy prices and energy stocks do well. And we see gold do well because physical gold, you don't keep it in the banking system. It gets out of your broker. You have that real store of value that's out of the hands of the financial system. And so gold is the biggest red flag. And the fact that it's hitting new all-time highs, which is what we have seen many times before, just before a stage 4 decline, is gold shoot higher and energy stocks do really well because people believe there's going to be more war, and war means high energy pricing. Doesn't mean it's going to happen, but people move into energy stocks and try to take advantage of that.
Yeah, okay, really interesting to see. And there's precious metals sort of in the top left and then also the bottom right. So is that something that they just do well throughout that down cycle, or does it do well at the top and then sort of there might
Yeah,
be decreasing at the bottom as well, or how's that?
yeah, good question. So precious metals will perform really well in a stage 3. So and we've seen gold move higher really the last couple of years, and it's pushing to new all-time highs. But what happens is when we go into a decline, almost everything sells off. You really don't want to be holding assets really of any sort because it's a financial reset. Everything gets revalued and usually at a much lower price. But what happens is after everything has been hit and beat up and there's bankruptcies and all of that stuff, precious metals tend to be the first kind of asset and pocket of stocks that actually come to life and they usually bottom a few months before the stock market does. So it's great right now. You don't want to hold it through a recession though, but eventually when the stock market has a big reset, when we see gold, silver, and miners start to turn up and outperform the stock market, that's when we're like, okay, this I think this bear market is coming close to an end. This stage 4 decline, precious metals become a very good play, especially the mining stocks. And the mining stocks, this is the phase where mining stocks take off. Not right here at a market top. Mining stocks generally lag and they struggle. But here is when the precious metal miners, when you can make hundreds or thousands of percent return, where stocks go from pennies on the dollar to worth 5, 10, 15 bucks. It's the big, this is the type, if you've ever been through one of these, I mean, these are life-changing financial situations in the precious metal space. The miners are the play. So that's one thing to look at when that time comes. Right now, I'd be like physical gold, which is what I've been kind of preaching for the last little while. It's the lowest volatility, the safest play, most likely to go higher. But when we get to the end of a stage 4 in a bear market and precious metals come to life, forget physical metals. They're going to be the slow slug. You're going to want to get into gold miners. So you have to understand, where we are in this cycle to know what part of the precious metal space to take advantage of.
Okay, that sounds good. And then how long do these cycles normally last? You said that it could go for a few more years, but say for the stage 1, is that 2008 that sort of turned around, or is that COVID, or where do you sort of see the baseline for that?
Yeah, so it really totally changes in different asset classes. Things can take several years. Things might only take 4 or 5 months to bottom. Bottoms are generally much more violent, quicker. Topping processes usually take longer, but there's nothing really set in stone. I think the market tops take a lot because the government and the Fed and all these people keep kicking the can down the road and manipulating numbers and doing quantitative easing and doing all this stuff to try to keep things going. They just don't want the game to end. They don't want to be part of a recession. So tops drag out, and we're seeing that. Bottoms generally will end with capitulation, a big wave of selling. Everybody freaks out. A lot of damage is done. Fear, is then entered into everyone's mind for the next 10 or 15 years, and they're scared of the markets. And so I would like to think the market would bottom, over the next year and a half, 2 years. It would find a bottom and start to flatline and start to turn higher. It's going to be really difficult. I think AI is definitely a wild card. I think there's going to be the rise of the machines. I think there's actually a Terminator movie called that. But I do think AI over the next couple of years, I think we're going to go into a very difficult market economy. And AI is going to continue to mature behind the scenes, and these robots that you can have, these humanoid robots in the markets, I think they're going to become a huge market. Everybody can have one in their home. They can have it to do stuff. Factories are going to start having them. So they might really spur this market higher. And I think we're going to see there's the industrial revolution. Well, I think there's going to be the AI revolution. We haven't even scratched the surface of what AI can do. And still, like ChatGPT and all those, you try to do stuff with it. I mean, yeah, they're great for basic stuff, but we're still super far from them being really good. And so there's lots of upside potential. I think the AI robotic space is going to be probably the next biggest and hottest sector going forward. And along with uranium stocks, I think uranium stocks are another one that are hidden, and they've been out of favor forever. And we live in a world of, we need electricity. And uranium is like the cleanest, most powerful way to get it. And there's a lot of these mini plants. I think we're going to see uranium facilities continue to pop up at a much faster pace, and they're going to become a really good play as the uranium space in general.
Okay, interesting. A lot of things to watch there. But I guess if we go back to the market dynamics, are you seeing sort of greater volatility in the markets? At least that's what it seems like from from someone sort of riding it up and down. It seems like things move a lot faster and a lot more
Yeah.
violently.
Yeah, things are getting more volatile. We're seeing prices rally very quickly. That is usually indicative of instability in uncertain market. Usually we see volatility increase near market tops. We also see volatility increase near market bottoms. Obviously, if we turn a corner and go into a bear market phase, volatility will naturally be higher for a much longer period of time. The volatility index will be up. Price swings will be bigger. Price gaps in the morning will be higher. I think we're entering a time of much higher volatility. And it doesn't help, having tariff wars and all this other news, which throws in even more. But I would expect people should expect 2025 and 2026 to be a pretty wild ride. much higher volatility, which means you need to either step back from the markets or have smaller positions because prices can move twice as fast as they have before. And if pullbacks used to scare you before, they're going to really freak you out when we go into a bear market because the market falls about 4 to 7 times faster than it rises. So it is a very wild ride if things turn south.
Yeah, okay, great. And what would you watch for to sort of figure out, okay, we've got into the bottom? Is it just that extreme acceleration and then I guess overselling, or what do you watch to then be like, okay, I'm a buyer?
Yeah. So, I mean, for a market top, I'm going to be looking for the longer term charts to turn down, right? I want to see like the weekly chart have bearish price action, lower highs, lower lows. We want to see higher volume consistently on the down weeks where there's obviously more selling volume. Volatility index will be higher. Small cap stocks will be getting beat up. Generally, the bias will turn very negative, and I think we'll just see the overall price continue to move down. In terms of a market bottom, we'll be looking for generally we'll be looking for some type of capitulation bottom, meaning we see everyone have a mass exodus. We'll see volume spike and price volatility spike up for a few weeks at a crazy, ridiculous level, and you're going to hear all kinds of stats of record outflows of the stock market and people moving away from advisors and all of that stuff because they're all there just buying and holding and they're riding this roller coaster down when there is no reason to hold something falling when you can identify the trend that it's in. So we're going to see like this mass movement out of the financial system and the advisor space, just like we did last time during a financial reset in 2008. And people give up on the market. They give up on the buy and hold. And usually right when everybody gives up and it's headline news consistently, that's when we start to see probably precious metals come to life. We'll start to see the odd sector starting to outperform and leading the way. That's where the early leaders will come in, probably robotics and precious metal miners and probably uranium and who knows what other interesting thing there'll be. And then we see the stock market turn around. Most people always exit at the wrong time, at the worst possible time, just before a major trend reversal. They get out and then prices leave them behind. So that's kind of some of the ways we look at it.
Okay, that makes sense. And if we look at sort of, I guess, the last few years, there's been the US exceptionalism. It's really outperformed the rest of the world. Do you see this being a global phenomenon of sort of a weaker market, or do you think there could be maybe it's a shift to emerging markets and other developed markets that haven't maybe benefited from this massive run up?
Yeah, that's a good question. I covered this in pretty good detail with in a mentoring session not too long ago with a bunch of investors, and it's really interesting. If you take all the different country indices, or ETFs, and overlay them with the SP 500, more or less they all move together. Just some move a little more to the upside or downside than the other, but typically, if you can nail down the SP 500, which the US is the biggest economy when it comes to the equities markets, and it really, to me, is like the tide. Know what the SP 500 is doing or the US markets, and you know what the rest of the world is doing. And so if you overlay all those charts, you'll realize they all generally are trending up at the same time. They all have lows pretty much dead on at the same time. And they're kind of all the same trade. I usually just stick with what I know best. So I don't invest in emerging markets. A lot of those other country indices and ETFs won't outperform the US markets. People go to the US markets for performance and for volatility, and they want to generate return. So I don't think there's any point in investing unless you have some very good insight. But the only one that really crazy bucks the trend is like the Chinese stock market. And it's all over the place and it's got way more manipulation than the US. So it is a real wild card. It has to be traded on its own kind of merits and analysis. But the rest of the world, we pretty much all trade together. We're either all rising in economic strength and value, or we're all plummeting and falling at the same time.
Yeah, and to be honest, it's a lot of it's most assets, isn't it? There's quite a lot of correlation between, even though you mentioned precious metals and all of this, there's actually still quite a lot of correlation between. So this everything bubble that we've seen over the past.
Yeah. Yeah, you really have to step out of the markets. A lot of people don't believe in a cash position. Cash position, though, during a bear market is probably one of the best positions. First of all, it doesn't require you to do anything. You're going to make a return on your money while everything else is getting devalued, and you'll be able to you'll have more money at the end of a bear market because you've earned interest and you've kept your money to reinvest it and buy these stocks that are going to have great dividends and lots of upside potential and all that stuff. But yeah, you're right. Almost everything goes down, and the only way to take a real advantage of it is to move to an asset that does, in most cases, rally when the stock market falls, which I find is the U.S. dollar index tends to do well. That is a play. It can substantially rise. The U.S. dollar index rallied. There's an ETF for it. It rallied like 17% in 2022, while the stock market fell. So there's ways to do that, and you can also play inverse ETF. So if the stock market falls 30%, you can buy an inverse ETF that will go up 30% or two times that, 60%. So there's all kinds of ways. Not only can we identify the markets and avoid market crashes, but then we can move to an asset that benefits from falling pricing. And that's where the real value and that's where the real growth definitely comes from active investors.
Yeah, and you meant and on your chart before there were treasuries, but then I guess if you look at 21, 22, they actually sort of underperformed as well because of that inflation risk that was seen in the economy. So I guess that's another risk that if inflation comes back with tariffs, etc., that they could continue to underperform. Then there's not really many safe assets at all, as you said, just cash.
For sure. Yeah. And like, as you said, like the bond market wasn't a safe haven. It collapsed. It fell just as much as stocks did. So people who had a supposedly diversified portfolio, a balanced portfolio, got absolutely slaughtered in 2022 because stocks and bonds both fell. And there's no reason people should be holding bonds. We were in a super strong rising interest rate environment. Bonds have fallen like 40% in value. It's one of the most craziest trades to hold. It's a very clear downtrend. That being said, I think most of the downside is done for bonds. I do think bonds have put in a major bottom. They're still basing though. They're in a stage one. They've been there for a couple of years already. And so some of these stages take a long time to play out. But I do think TLT, like the long-term treasury bond in the United States, I do think eventually we're going to see rates start to go down. We'll probably see bonds move higher. So I think there'll be a very good play. I think it's a little early still right now, but I do think we're going to come back kind of to the norm, the good old days where we were kind of in a falling interest rate environment. Bonds go up on the days stocks go down in most cases. We kind of are seeing that as the day you and I are recording this, and it's kind of a nice feeling to have a normal. It's like a flash of normalcy again, but it's short lived. It's just these markets are still wild, and the key is bonds will become a play down the road, but it's still bottom picking, and it still might not really perform for another 4, 6, 8 months, which is a long time to just kind of sit there when there is opportunity in other places.
Yeah, definitely. So, Chris, thanks so much for sort of gone all over the place. But my last question is, what is one message you want people to take away from our conversation?
I think if somebody to take away from it, I would more or less say if you have a diversified portfolio of stocks and bonds and you own a whole bunch of sectors and individual stocks, I would look really carefully at how your strategy is when we enter a bear market and how quick your strategy will react to get you out. Because once it starts to fall, holding sectors move a lot faster than the indices, meaning if the stock market falls 30%, a sector is probably going to fall 50 to 60%. And if you hold individual stocks, which everybody seems to have a handful of their favorite stocks, those stocks usually fall 60 to like 95% during a bear market. So, you think you're diversified by having stocks and sectors and indexes, index ETFs, but all of those actually increase your volatility. They will increase your losses and pain. And so have an exit strategy. Understand there's a time to own assets and a time to sit on the sides or benefit from falling pricing.
Yeah, definitely. They're uncorrelated until they're not, and then they're all going down at the same time. I guess that's a issue with these crashes. But yeah, thanks again. If anyone wanted to find out more about your work and what you do, Chris, where would the best place for that be?
Yeah, best place to go to YouTube at The Technical Traders or my website, thetechnicaltraders.com. And I've got a free newsletter there. You can watch some of my video analysis. And if you see what I do and it makes sense, then you might see a whole new way of investing in the markets. So, yeah.
Great. Thanks again. I'll pull down the description, but thanks again for your time.
Thanks, Anthony. Take care.
Hey, everyone. Thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching and see you on the next show. And you also might like this video right here. All right, thanks again.